The equity instrument is carried at cost, no further adjustment to be made, carrying value after initial recognition. This is the most important point, my friends. Just 1 minute. Friends, we are solving practical problems and solutions on IND-AS 109. What is IND-AS 109? IND-AS 109 speaks about IND-AS 109 speaks about financial instrument. If a document, if an instrument is covered by IND-AS 109, then only IND-AS 109 will speaks about the accounting treatment. If a particular item not fall under IND-AS 109, friends, what I want to tell you, see, I'm talking here regarding to financial instrument IND-AS 109. While speaking about IND-AS 109, the item should fall under IND-AS 109. Then only it's talk about accounting treatment. Friends, what I would like to talk here about IND-AS 109. First, the moment I speak about IND-AS 109, any instrument, if it is a financial instrument, then it comes under the placing under the financial instrument. The moment the word financial instrument come, it's covered by IND-AS 109. The accounting treatment will be done by IND-AS 109, friends. So the IND-AS 109 speaks about the accounting treatment. So the accounting treatment, what we are going to talk here with respect to IND-AS 109, I would like to talk that the IND-AS 109 speaks an instrument which is fall under the NDS 109. So an equity instrument is carried at cost and no further adjustments to be made. The carrying value after initial recognition. See, for example, I'll tell you one transaction. A B Limited issued compulsorily convertible preference shares, rupees 100 each, 10 rupees face value and 90 rupees premium per share. For 10 lakh rupees, these are convertible into equity share at the end of the 10th year, where the number of equity shares to be issued shall be determined based on fair value per equity share to be determined at the time of conversion. What if the conversion ratio was fixed at the time of issue of preference shares? For that, what I would like to treat the here, in this case, conversion of the convertible preference shares into a fixed number of equity share at the end of the year, then it means the definition of equity and hence shall be classified as an instrument. An equity instrument is carried at cost and no further adjustment to made to carrying value after the initial recognition. Understood, friend? After initial recognition. See, a similar way, we'll see another example. Example D. A Limited issues preference shares to B Limited, a holder. Those preference shares are redeemable at the end of 10 years from the date of issue and entitle the holder to a mandatory dividend of 15% per annum. The rate of dividend is commensurate with the credit risk profile of the issuer. One minute, friends. My friend is calling. Friends, sorry for your disturbance. Now the question is speaking like this. What I would like to tell you here, the thing is, the point is, the match is a limited issuer issue preference shares to who be limited as a holder. Those preference shares are redeemable at the end of the 10 years from the date of issue and entitle the holder to a mandatory dividend of 15% per annum. The rate of dividend is commensurate with the credit risk profile of the issuer. LMN Limited issues preference shares to PQR Limited. These preference shares are redeemable at the end of 5 years from the date of issue. The instrument also provides a settlement alternative to the issuer whereby it can transfer a particular commercial building to the holder whose values is estimated to be significantly higher than the cash settlement amount. Friends, I would like to tell here see, the question is A Limited issue preference shares to be limited holder. Okay. Those preference shares are redeemable at the end of the 10th year. Okay. From the date issue of the entitle the holder to a mandatory dividend 15% per annum. The rate of dividend is commensurate with the credit risk profile of the issuer. Then we'll see how to classify this instrument, dear friends. This instrument provides mandatory fixed dividend payment and redemption by the issuer fixed amount at a fixed future rate. Since there is a contractual obligation to deliver the cash, both dividend and repayment principal to the shareholder, that cannot be avoided instrument is a financial liability of the entity. Friends, what I would like to tell here, the instrument provides for mandatory fixed dividend payment and fixed payment and redemption by the issue of the fixed amount at a fixed future date. Since there is a contractual obligation to deliver cash, both dividend and repayment of the principal to the shareholder, that cannot be avoided, instrument is a financial liability, in its entirety. Friends, for example, A Limited issued a warranty entity, the shareholder, the purchase of the equity shares of the come at fixed price. So it constitutes a contractual arrangement for issue of fixed number of shares against the fixed amount of cash. The warrant means the definition of the derivative. So as India is 32, a derivative contract that will be settled by exchange of the fixed number of shares for fixed amount of cash meet the definition of equity instrument. The above contract, a derivative contract that will be settled by issue of fixed number of own equity instrument by A Limited for fixed amount of cash. Hence, it meets the definition of an equity instrument. Friends, I would like to tell here what I want to tell here. See, we are talking about financial instrument. We are talking about the financial instrument. When the moment of the transactions given to us, we need to arrive its derivative instrument or financial instrument, or this is just current liability. So the moment you understand the transaction, you can correctly classify it's come under Ind AS 109 or not. If it comes to the Ind AS 109, what is the accounting treatment? That is our main objective, my dear friend. Let's look into another transaction, my friend. LMN Limited issued preference shares to PQR Limited. These preference shares are redeemable at the end of the 5 year. From the date of issue, the instrument also provide a settlement alternative to the issuer, whereby it can be transfer a particular commercial building to the holder whose value is estimated and to be a significantly higher than the cash settlement amount. Dear friend, if you look here, You need to understand the question. The question is 𝒟𝒁 Limited issued preference shares to PQR Limited. These preference shares are redeemable at the end of the fifth year from the date of issue. The instrument also provides settlement alternative to the issuer whereby it can be transfer a particular commercial building to the holder whose value is estimated to be significantly higher than the cash settlement amount. Then what accounting treatment we'll see here, my dear friend? This instrument, this instrument provides for mandatory fixed dividend payment and redemption by the issue of fixed amount at a fixed future rate. Since there is a contractual obligation to deliver cash, both dividend and repayment of the principal to the shareholder, that cannot be avoided, instrument is a financial liability in the entirety. Dear friends, I would like to talk about the a question. You please understand what question is speaking. The entity can avoid a transfer in cash only by giving such high value building, which is substantive, thus such a preference shares are financial liability. Understood, my friend? See, basically, what I want to talk here, what I would like to tell here, the thing is, the thing is, this instrument provides for mandatory fixed dividend payment and redemption by a fixed at a fixed future date, since there is a contractual obligation to deliver cash, both dividend and repayment of the principal to the shareholder, that cannot be avoided, instrument that cannot be avoided, instrument A limited issued warranties entities A limited issued warrants entitling the shareholder to a purchase equity share of the company at a fixed price. So it constitutes a contractual arrangement for issuance of a fixed number of shares against a fixed number of cash. This warrant meet the definition of derivative as India 32, a derivative contract that will be settled by exchange of the fixed number of equity shares for a fixed amount of cash meets the definition of the equity instrument. The above contract is a derivative contract that will be settled by issue of fixed number of own equity instrument by a limited for a fixed amount of cash. Hence, it meets the definition of an equity instrument. This instrument, and the second question which I studied, this one, what that question first to understand. A limited is a issuer of the preference shares. to B Limited holder. Those preference shares are redeemable at par at the end of the tenure from the date of issue and entitle the holder to a mandatory dividend 15% per annum. The rate of dividend is a commensurate with the credit risk profile of the issuer. For that answer is this contract provides for mandatory fixed dividend payment and redemption by the issuer of fixed amount at fixed future date, since there is a contractual obligation to deliver cash both dividend and repayment of the principal to the shareholder. That cannot be avoided instrument. That's called is a financial liability instrument. In this entirely, my friend. Let's go for another question. We'll see how they will be recognized as a financial instrument. Dear friends, if you go see question number G, question number F, it's talking about LMN Limited issued preference shares to PQR Limited. These preference shares are redeemable at the end of the fifth year from the date of issue. The instrument also provides settlement alternative to the issuer, whereby it can transfer a particular commercial building to the holder whose value is estimated to be significantly higher than the cash settled amount. Cash settled amount. Friends, you understand the question? The question is you need to understand properly. The moment understand the question, we can easily answer. So we need to understand the question and what concept they're asking. If you understand both, it is very easy to write the answer, my dear friends. Friends, let's go back to your question. The question is talking about I am LMN Limited. What I did, I issued preference shares to Mr. PQR Limited. These preference shares are redeemable at the end of the fifth year. From the date of issue, okay, from the date of issue to till the 5 year, the year of end of the 5 year, I will pay. Now, the instrument also provides a settlement alternative to the issuer, whereby it can transfer a particular commercial building to the holder whose value is estimated to be significantly higher than the cash settlement amount. Understand, my dear friend? Let's go back to discuss. The entity can avoid a transfer of cash only by giving high value of the building, which substantiative in a financial liability in its entirety. Okay, friends, let's go back to discuss question number F. Yes, we talked F only, now. Now, let's go for question number G. The question number G speaks about the question G Limited issue convertible debentures to B Limited for a subscription an amount of 100 crore. Those debentures are convertible after 5 years into equity shares of A Limited using a predetermined formula. The formula is 100 rupees into 1 plus 10% whole power 5 divided by fair value on the date of conversion. For this, what accounting treatment I am going to talk here, friends, let us go and see G. The entity is using its own equity instrument as currency. Such contract is a financial liability of the entity even though the entity can settle it's by delivering own equity instrument. By delivering its own equity instrument. It is not an equity instrument because the entity uses variable number of instrument, variable number of own equity instrument as means to settle the contract. Friends, this question is very important. Let's go back to discuss again. What question speaks? First, we need to understand. Then, what India's 109 treat that item? We need to see. Based on that, we need to come to the conclusion. Let's go back to the question number G. The question number G speaks about A Limited issue a convertible debentures to B Limited for subscription amount 1000 crore. Those debentures are convertible after 5 years into equity share of A Limited using predetermined formula 100 crores into 1 plus 10% whole power 5 divided by fair value on the date of conversion. Okay. For this, what is the accounting treatment? We'll see. Friends, here we need to understand the interpretation of the question, interpretation of the India's 109. In what intention it's telling that financial instrument and what context it's telling it is not a financial instrument. So we need to understand that heart of India's 109. Then we can easily to answer this question. Let us see what is it. What is it? Here, the change in the fair value of equity shares arising from market related factors do affect the amount of cash or other financial asset to be paid or received or the number of equity instruments to be received or delivered. Hence, this contract is an equity instrument. This contract is an equity instrument. Understood, my friend? In order to fulfill is a financial instrument, what are the elements should be covered? What are the elements it should fulfill? We'll discuss now. 1 minute. Dear friends, we need to understand that what are the elements or the important criteria to could say it is a financial instrument. The first and foremost important thing is that the moment where you fulfill that, then you will understand issuing is a financial instrument or not. Let's come back to the discuss just 1 minute, my friends. I'm talking about India's 109. Friends, basically, India's 32 is the presentation of the financial instrument. India's 109 is the recognition and measurement principle. India's 107 is the disclosure of the relating financial instrument. See, the definition of the financial instrument, it is a contract between two or more parties that gives rise to a financial asset, one entity, and financial liability or equity instrument for another entity. The existency of the contract is the mandatory. It can be written or oral or implied. So the financial asset is any asset that is a cash or an equity instrument of the another entity, a contractual right to receive a cash or other financial asset from the another entity, a contractual right to exchange the financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. So a financial liability is any liability that is a contractual obligation to deliver the cash or other financial asset to another entity. A contractual obligation to exchange the financial asset or financial liability with another entity under condition that potentially unfavorable to the entity. A contract to issue the variable number of shares or fixed number of shares for variable consideration. This is called financial liability. Till now, what we spoke here, what is financial asset? What is financial liability? Whether all those deal by India's 109 or not. Okay, friends, let's go back to discuss. Okay. Friends, give me some time. I'll take break 5 minutes and then I'll reconnect you by one more video with respect to financial instrument problems and solutions. Thank you, my friend. Thank you very much to watching my YouTube channel. Thank you very much. Bye. I'll come back to you after some time.